a comprehensive guide to building a resilient cryptocurrency portfolio through strategic diversification, smart allocation practices, and avoiding common investment pitfalls. A robust cryptocurrency portfolio strategy branches into four essential elements: asset allocation across different crypto types, risk management tailored to your comfort level, regular rebalancing to maintain your plan, and security measures to protect your digital wealth. This allocation strategy distributes investments across four key categories: 40% in large-cap cryptocurrencies for stability, 30% in promising altcoins for growth, 20% in stablecoins for steadiness, and 10% in speculative assets for higher-risk opportunities. Portfolio tracking tools help investors monitor their cryptocurrency holdings in real time, displaying vital analytics that reveal how market movements affect their investments and when adjustments might be necessary. When market changes occur, like an unexpected surge in altcoin values, they create ripple effects, throwing portfolio balance off its intended proportions, triggering new investment decisions, and highlighting immediate rebalancing needs. Comprehensive security for your crypto investments includes hardware wallets such as Ledger or Trezor, which provide crucial protection against online threats by storing your digital assets offline. Savvy investors rely on a collection of research resources, from platforms analyzing market sentiment and tracking development trends to sources monitoring regulatory updates, all helping them adapt quickly to the evolving crypto landscape. Diversification emerges as the cornerstone strategy for cryptocurrency investors, spreading funds across multiple assets instead of risking everything on a single coin in this highly unpredictable market. By distributing investments across various digital currencies, this approach simultaneously shields investors from excessive risk, buffers against the market's notorious price swings, and strengthens long-term security against devastating losses. Cryptocurrency types branch into four essential categories for a balanced portfolio: large-cap coins like Bitcoin, promising altcoins such as Cardano and Solana, stability-focused stablecoins, and utility tokens connected to specific platforms. The fundamental cryptocurrency investment dilemma pits stability against growth potential. Established coins offer security with modest returns, while riskier alternatives present opportunities for substantial gains alongside greater volatility. A well-structured crypto portfolio resembles a carefully arranged basket, with different-sized allocations to major coins like Bitcoin and Ethereum, alongside smaller positions in altcoins and stablecoins for balanced exposure. Bitcoin and Ethereum function as the established anchors in any diversified crypto portfolio, with these market leaders providing a foundation of relative stability compared to their more volatile counterparts. Dogecoin, Shiba Inu, and other meme coins form the speculative edge of crypto investing. These community-driven tokens offer excitement and potential explosive returns, but should occupy only a small slice of your investment pie. While the crypto market regularly experiences dramatic price fluctuations, stablecoins like Tether and USD Coin stand in direct opposition to these swings by maintaining consistent value pegged to traditional currencies. Even the best cryptocurrency diversification strategy faces three major investment pitfalls that can derail your success. Over-diversification dilutes returns by spreading across too many assets. Impulsive decisions based on market hype ignore crucial fundamentals, and security negligence puts your private keys at risk of theft. Smart investors take time to thoroughly analyze cryptocurrency options across multiple platforms, keeping their hardware wallets secure while making deliberate, well-researched choices rather than hasty decisions. Conducting thorough research into each cryptocurrency's fundamentals consistently delivers better results than simply following the crowd's enthusiasm, which often leads to buying at peak prices based on hype rather than value. The 60-30-10 rule offers a practical framework for cryptocurrency allocation, suggesting investors dedicate 60% to established large caps, 30% to promising mid-cap altcoins with growth potential, and 10% to high-risk speculative bets that could deliver outsized returns. Recent market activity shows Bitcoin fluctuating between $64,000 and $58,000, while Ethereum trades in the $2,500 to $2,800 range, and certain altcoins have dramatically outperformed these major cryptocurrencies with significant price surges. Resilient investors who proactively adjust their holdings based on changing market conditions consistently outperform those who remain static and get caught unprepared when cryptocurrency markets suddenly shift direction.